Hi, welcome to Commodities Corner. Just as UBS is sorting through Credit Suisse's assets, properties and personnel, it's also taking on its former rival's carbon emissions. And that will be a burden for UBS, given that it has a lower emissions profile. Our guest says that, broadly speaking, UBS is in much better shape when it comes to sustainability and climate risk, and that adding Credit Suisse will be a drag. We're joined by Christoph Klein, Managing Partner at ESG Portfolio Management in Germany. Christoph, thanks very much for joining us.
Thank you very much for having me.
So give us an idea of what we're talking about. Companies in Europe especially are coming out with these ESG scorecards, and carbon pollution is a big part of that. But does it really matter, these scorecards? I mean, is it just public relations and about public image, or is there a real financial impact here before we get going onto the difference between the two banks?
Yeah, absolutely. So ESG matters, and there are many, many dimensions. As you absolutely say, there's ESG quality. Some look at ESG ratings. Many look a lot deeper on specific ESG KPIs and factors. Then it's certainly about impact. Is it on the impact on the Sustainable Development Goals? So it's not only ESG, but many start here. And then, as you also said, climate risk is obviously absolutely crucial. And then, we need to compare and, again, look into the numbers.
If I'm a bank, though, if I'm the management of a bank, why do I want a good ESG score? Does it actually mean anything for my profits?
Yeah, absolutely. So ESG, there's so much research out there that in the first place, many say and agree, ESG management is about risk management because, in many dimensions, you can do awful things. Certainly very well known are emission, pollution, but also the social factors. Why is there such a big gender pay gap? Is it really justified? Why is it that big? So much things can be improved. And indeed, if you have a poor reputation, you might lose clients, you might lose employees, they might be less happy and leave, the turnover is higher and so on. And this might spill over into financial impact. So it's, I would say, prudent ESG behavior is also good risk management. So it does matter.
Okay. So give us an idea. Credit Suisse just had not done as well on many scorecards on the environmental front. We're sticking to the environment here, carbon particularly. Mm-hmm. Tell us about that, please.
Yeah, I like to refer to a very, very important organization here. I would say it's a global standard setter on climate, and that's CDP, that stands for the Carbon Disclosure Project. And here Credit Suisse got a downgrade to C, which is not that great. Whereas on the other hand, UBS has a single A, an A which is really outstanding. So this is quite the opposite direction. And this is certainly a big contrast here.
Will it be expensive for UBS to bring up those Credit Suisse assets to its own standards? For example, would it be tempted to just divest a bunch of coal loans, for example?
Absolutely. That's a big question right now. So to enhance standards and policies, to rewrite that, to harmonize that, that's not a big issue. That doesn't take a lot of time. But as you say, to adjust portfolios, that's a different matter because some of the things are not that liquid. You might have a bid-ask spread here. But on other contracts, so say loans, some private investments, some infrastructure investments, they might be very illiquid, and maybe others are a bit reluctant to step in. So there might be a big cost to get rid of that.
There's an interesting thing here. Bloomberg had this story that Credit Suisse has been involved in these deals in which developing countries such as Belize can reduce their debt burden in exchange for making commitments to the environment. Now, these have been criticized for their murky structure, a lot of the so-called debt for nature deals, people wondering about the special purpose vehicles, etc. People wondering about, is there a real benefit here? So what will UBS do with those deals?
Yeah, I think this is a very interesting and, as you say, complex asset class. So what is it? Debt for nature swap. So very often you get a cheaper financing deal, and with that reduced financing cost. With that amount of money, you hopefully invest in something to support the biodiversity, for example, or to stop cutting rainforest and these kind of things, which are absolutely very, very helpful. The question is, how long does it last? And what are the metrics? what's the transparent reporting there? And in the first place, on the deal, would you get a second party opinion like we expect from any good green bond, for example? And that's why I agree, like you said before, some of these deals might be a bit murky, difficult to check, and that's not so straightforward to a green bond. But the general topic that poorer areas, nations, need certainly some funding and financing to get there is certainly quite necessary.